Now, the fourth aspect of how to identify good pre-construction projects is its investor value. You have to do an assessment in terms of, is this project properly aligned for your investment and your investment time. So for example, you have to assess, are you a long-term investor, are you going to be a short-term investor? And if you're going to be a short-term investor, then you have to make sure that you have the assignment clause. We always make sure to get our clients the assignment clause, regardless of even if you are, but you certainly have to make sure, what is the assignment clause, does it have it, can you sell this property on an assignment, is there any fees, if so, how much are those fees, and what is the assignment based on. So you have to make that assessment when you are making your decision, in order to again reduce your risks and maximize your profit potentials. The second element of it is what types of incentives, investor or incentives that the builder is giving you in this particular project. For example, is it free parking, locker, capped development fees, any designer credits, any rental guarantees. All of these incentives helps to botch up your investment. The other element of it that you need to consider, which is your deposit. Again, how much of a deposit are you putting down in terms of the property? Is it going to be 10%, 20%, 15%, 5%? That helps to determine the level of leverage that you're making, and that defines how much risk you're able to take, or how much of a profit potential that this would take. Like, I'll give you an example. Earlier this year, there was an investment opportunity that came. The builders were certainly new. Again, it's the number one rule. The builders were certainly new. We have to consider them. So it was a little bit, because they were new, it was a little bit challenging, it was a little bit risky, but the deposit structure that they had was only $30,000 you had to put down for a $700,000 townhouse. The risk level there was very low for your deposit, and especially if it is money that you can take a risk on, no problem, that was a good investment. So the deposit helps to determine how much of a risk that you can take and how much of a leverage that you have. That's a very important element of it to consider when you're making a decision. Also, how delayed and extended that deposit structure is. The more delayed and the more extended that is, the more time you have, and the more returns you're going to get. The other element of it is going to be the liquidity of that particular project. So you have to consider how liquid is this project, when is this project going to be sold, what is the intrinsic value of the building. All of this helps to determine whether a project is good or not. And lastly but not least, you have to consider in the project, when is this project going to be completed. There are certain projects that gets completed in a year, and then there are other projects that gets completed in 4 or 5 years. So you have to decide how long of an investment time period can you take. Now, what is the advantages and disadvantages of both? If the project is completing in more years, let's say for example you invest in a condo project that's completing in 4 years, well, that means is that you have 4 years of potential growth. There is sufficient time for you to grow. It's a little bit more safer, it's a little bit more secure, because remember, real estate generally does not grow in a very linear fashion. It grows, exponentially. It grows and then stagnates and then grows and then plateaus. So when you have more time and the project is completing in more years, you have more opportunity to capture big jumps, and as a result get more returns, and it's safe because then potentially the market will go up. There's 4 years, for example. Whereas, for example, most often than not, detached and types of properties, townhouses, semis, they usually get completed, in a year to a year and a half, sometimes even less time than that, sometimes even 6 months. So you have to consider, is there sufficient time for the market to grow up until that time? You know, sometimes clients come and say, you know, they're like, we don't like to invest in condos, we want to invest in homes, because, you know, homes, there's always more demands on it, and it can jump and it has the big potential. True, 100%. It has more opportunity to give you higher reward, but it's also higher risk, because you're purchasing it at prices that are usually above market, and then they're usually closing in a shorter time period. Is it gonna be within a time period where it's gonna make the jump, or is it gonna be within a time period that is going to remain stagnant? And if it is stagnant, you have the holding power until it becomes higher. So the time period of when the project is going to be completed is a very important element for you to consider based on how your investment profile is. So again, you have to consider the investor value that it potentially brings, the deposit, the assignment clauses, the development fees, the different types of incentives that the builders can provide, the liquidity of the project, as well as the project completion time. All of these things help to determine whether you should invest in a particular project or not, and it is something that you should definitely consider. So to sum it up, there are 4 key elements that you have to, it's important that you must analyze each and every pre-construction project on these key 4 elements. Number 1, the developer. How strong are the developers? Number 2, does this project have any edge, and what are the types of edge? The more the edge, the better it is, the more secure your investment is. And the third element of it, what is the value of the project and the pricing of the project compared to the market? And number 4 is the investor value to you. By assessing all of, and a combination of all of these 4 elements of it, you can make easy determination as to, is this a good pre-construction investment? And this is something that we're going to be constantly referring to in each one of our projects that we work on and that we launch. We're going to analyze and assess each of those projects based on these elements so that you are confident in the investment that you make.